people to come, but most of the audience is here already, so
Whenever you're ready.
we would rather spend your time, David, talking than just standing for the group. So hello, everybody. My name is Andrei Kunov, and I'm the president of Silicon Valley Innovation Center. We organize executive education programs, master classes, and workshops here in Silicon Valley. Thank you for coming today. We have a great speaker today, David Shen. David is you are the founder of right, the investment fund, which is
It's just my angel investing operation.
David used to work at Yahoo at some of the executive positions, and he later became a very successful investor. He had a number of successful exits, as far as I know. And then now you're working as an investor as well. So he's going to give you a presentation today about the early stage and Series A investment opportunities for international startups. And David will be able to give more information about himself right now. Please feel free to talk to him after this presentation, but then you will probably have to go. How much time would you have after this talk?
I have some time for questions.
Great. Thank you very much, David. So please, the stage is yours.
Hi, everyone. Thanks for giving me the opportunity to speak to you about investors. I was asked to come here and talk to you about the different ways that people can raise money. So I'm hopefully some of this will help all of you here. I'm director of West Coast director of Launch Capital. I do investments here in the Bay Area and also in New York. And I've also been investing since 2006. So I've gotten the opportunity to see the startup world before the economic crash in 2008 and also after it. And it's changed quite a bit from 2006 till today. Yeah, I used to work at Yahoo. I ran user experience there. Then before that, I was at Frog Design doing consulting on product design. And then I was at Apple for 3.5 years before that, doing more product design. So I've had an interesting career, and hopefully some of that will have helped me in investing. Okay, so before I jump into the different types of investors out there, I thought I'd go over some trends that we see in the US in the seed funding world today. So one thing I thought was really interesting was a lot of people used to raise seed at, say, a couple $100,000 or maybe $1 million. And that's what it was like when I started in 2006. But in today's world, look, the first time they raise money, they're raising like $3 million or greater than $3 million. And so I believe that, and I'll talk a little more about this later, is in direct relation to how hard it is to start and get a company off the ground. You simply just need more money so you can survive longer or to go buy customers. Okay? And investors know that, so they're giving seed companies more money. Now look at this. Some companies are even getting over $6 million the first time out, okay, which is really unusual. And again, I think that's in reaction to the fact that it's just really hard to start a company in the US today. So again, a lot of people out there just simply are not raising enough. Seed rounds are going up to $2-3 million. Just getting customers is taking too long. Especially when I see startups, often I meet one, and then I'll go on Google and I'll search around. There's often 2, 3, 10 other people working on the same thing. So when there's more than one startup working on one thing, everybody slows down. And the death timer is your bank account, because that's ticking down. If you can't grow customers fast enough to balance that out, you'll die. Okay? Also, we're seeing that B2B sales cycles are going way longer than a year, sometimes 18 months, maybe even 2 years before someone will actually use your product. So it's not only happening in consumers' world, but it's also happening in the business-to-business world. Our guess, although I forgot to change this number, is that it takes about 24 to 36 months now from when we first give you money until you either get metrics good enough to get the next round or you get to break even. Okay, and that's a long, long time. It used to be that you could raise that next round in only after a year. So a lot of people in Silicon Valley like to talk about bubbles, so I'm going to put my bubble talk up here now. I believe there isn't necessarily a bubble in any other part of the industry, but I do believe that there is one in the seed stage, early stage. And you can see how this is in, let's see, 2013 here, right? That's the most amount of startups that got funded is in seed, okay? And it just keeps growing from year over year over year. Our count's probably, I'll probably go into this in a little bit later. I mean, there's thousands of startups running around in Silicon Valley right now. Everybody wants to build a new company. Some of the problems will come with that is just too much competition, not enough money raised, too many opportunities. Okay, so here's another graph that talks about that. So this graph is actually what they call a merger and acquisition graph. So this is the median of exits if you look at only online and internet startups. And it's probably sitting right around, I don't know, $12 million, okay? But if you think about what is the average valuation that people raise at, which is $5 or $6 million, I mean, that just doesn't help us investors think about making money at early stage, because way too many will die as we invest in them. But if we don't make back the money that we lose, that's going to be a problem. Okay? We can still make some money if the valuation is good enough at the early stage, but that's really hard to find because a lot of those valuations have risen over the years. We have something called an acqui-hire, which is basically, you got somewhere and then you couldn't get, sold yourself to Google or Facebook for not that much money. It's unfortunately a great way for us to lose money, but I think you guys as entrepreneurs reap a lot of that winnings because you get to work at Facebook. That's awesome, right? Free food, exercise room, whatever. It's pretty awesome. Okay, so rolling into the types of investors out there, the first group I'll talk about is angels. So what do angels invest in? Still, internet dominates the number of investments, but what's interesting is healthcare is less than half of that, but yet it's got almost the same amount of money. Okay, and healthcare's been around for a long time for angels to invest in. So where do they live? Well, a lot of them live in California, where we are right now. All these hot spots are kind of where people are. You can see some of the popular places where they also have incubators and things. New England, Boston, New York, all that area is a pretty big area too. All right, so who are angels? Most of them are just high net worth individuals, just people who have made money over the years. They can also be family offices. A rich family may have a bunch of people investing on their behalf. Except in the places where they see a lot of startups, they can be conservative. They can require revenue and traction from a startup that almost doesn't make sense to have revenue traction at the early stage. And definitely are not used to investing in startups with less defined business models. So things that we might tolerate over here on the West Coast, you might go over there and they'll just like, well, show me your business plan. You'd be like, what are you talking about? So yeah, we see that a lot. We've heard about that a lot from startups that come over to the West Coast. Angels can also invest in all amounts, ranging from to millions. So why do angels invest? First, the obvious one is just to make money. Fame can be another one. I can brag to my friends that I invested in Facebook before they went public. Supporting something that they are passionate about. So I love, your thing, or my mother had cancer, so you're working on cancer, so I'm going to give you money because you're doing that. There can be those kind of reasons. Relationships is a big one. Friends and family can often raise money from rich family members. Or maybe you worked with them before. As long as they know you and they trust you at some level, they might give you money. And some people out there have bigger aspirations than just staying an angel. They are trying to build a portfolio to raise a fund with. So we've seen that over the years where angels have become venture capitalists. What do they like in startups? Well, first, you, most importantly. Hopefully they like you as a person and like to hang out with you. Then I find there's two types of angels out there. There's ones that just say, show me the product. And they just want to see what you're working on now, and they got to fall in love with it. It's got to have awesome user experience. It's got to look good, all that kind of thing. And then there's the other type, which they want normal investor requirements. I tend to be one of these guys. Like I always ask people for, well, what's your vision? Like where are you going to take this thing that I see, which is one web page, how's that going to be a multi-billion-dollar company? So there are people like us out there, although you may meet some who just want to invest in some awesome-looking product. Okay, another way that you can raise money in the U.S. is through crowdfunding, and from not so rich people. So there's been a rise of crowdfunding over the last couple of years. Some of these names you might recognize, like AngelList, Circle Up. These are also startups, but they allow you to invest into a pool of money that goes and invests in another startup. Okay, and sometimes they're really good because they give you opportunities that you wouldn't have seen if you had just been out there normally. So they help bring those opportunities to you. Generally, you got to be accredited to participate. Accreditation in the U.S. means you have to have a certain amount of wealth or make a certain amount of money every year. It's basically protection for the smaller investors who may not have as much experience. But some of them are allowing non-accredited investors on the assumption that the Jobs Act, which I'll talk about next, will come into play. Actually, not next, but one after this. Another form of crowdfunding out there is the ones that started by Kickstarter. So you can put up a project or a product on the site and then ask for money. And if somebody loves your product, they can say, I pledge $100,000 or $1,000, $100, whatever. And over time, you might be able to raise as much as, say, Scanadu, $1.2 million, or even the Pebble Watch, which raised like $9-10 million on Kickstarter. Okay, but a lot of these are also on Indigo and MedStarter. Okay, a lot of text here. The Jobs Act was an attempt to allow everybody to fund startups, to do private investing. Last year in July, part of the law came into effect where it allowed people to publicly say, I'm raising money for my startup. But there are a lot of rules to follow, and if you broke them, you could be banned for investing for raising money for a whole year. So not many people are actually doing this because they're really afraid that if they screw something up, then they could be in big trouble for a year. The other one that hadn't come into play yet, that almost came into being this year, but then I think got yanked back into discussion, was just letting anybody out there invest in startups. There's a lot of controversy over this law right now, so we'll see if that will help. Come into being later on this year, or maybe next year. Okay, another great way, I'm a big fan of this, to raise money is to join an accelerator or be part of an incubator. So what's the difference between an accelerator? Accelerators, you join it for a small investment, often at a really low valuation, but you get lots of help. That's mentorship and advice. I'm a mentor actually at 500 Startups. I enjoy doing it. I've been mentoring since batch 1, and it's a great way to help and see a whole bunch of startups all at once. And then at the end, there's usually a demo day, basically a big pitch presentation event where investors will sit in the audience, and then you go up on stage and pitch your startup to them. I think the big difference between an incubator and accelerator is generally the ideas come from within. So somebody who owns the incubator say, oh, we should do something this, but then they assemble a team together and build a company to go after that idea. And generally, all of the startups will sit together in a single space. So since I think the first one that came out was Y Combinator back in 2006, 7-ish, something like that. I mean, there's something like 422 accelerators in the US. And that was last year's count, so I'm sure there's even more than that. So there's plenty of accelerators to join. They range it from tech ones to even things like medical device ones and hardware startups. But you can pretty much find an accelerator for any category of startup that you want to build. So what's the advantage of an accelerator or incubator? You get lots of help. You get to meet to a lot of other startups and share ideas and get help. The exposure to investors at demo day helps reduce your work. Otherwise, how are you going to get introduced to all these people out there? And we've seen valuations jump simply because you came from a certain accelerator or incubator. So if you go through Y Combinator, their valuations once they get out are typically from $8 to $12 million. Okay, so it's a lot higher than what you've gotten if you just been out there by yourself. So some disadvantages are maybe you don't like ownership. It's typically like you get about $100,000 for 10% of the company, and that varies from company to company. Also, you may be forced to move to the accelerator's location. So if you lived somewhere else, everybody makes you go to San Francisco to join 500 startups and sit in Mountain View for 3 months. So that may or may not be a good idea for you. One trend that we're seeing through accelerators is that a lot of startups now are going through more than one program at once. Because what happens is they give up ownership for that, but then they know they can pump up their valuation when they raise money every time they go through an accelerator. So that's why they like doing that. All right, the next group of people to raise money from are seed and micro VC funds, or what I like to call seed plus funds, and I'll explain that in a little bit. So there's a lot of them out there. 135 by this table's count. There's probably even more coming in day by day. Here's the top seed micro VCs from 2011 to 2014. These are the most active ones. So you can see, again, the list here. In case you were wondering, we like to put up statistics about everybody. We like to compete on everything. If you want to raise the biggest Series A rounds, you want to get your money from Wedge Swan Ventures or Crunch Fund or Softtech. Here's another graph. Who gets the Series A fastest? And here we are sitting way out here as the slowest one out there. I'm not sure we're proud of that or not. But ENIAC Ventures here is the fastest of Series A. So what are they like? They typically raise a fund that's from 5 million to 100 million. Usually they are the first money or second money in. Are you familiar with equity funding and notes with caps and those kind of things? Okay. Most new funds are okay with notes, but older funds almost always will do an equity round. Okay. Older, larger funds will almost always demand traction metrics. So that's been kind of frustrating because a lot of the people that I used to invest with back in 2006 now have gotten beyond me, meaning they demand 25 to 50K a month in revenue before they'll even consider you. Okay. Oh, a note is like a loan, and oftentimes we do a convertible note, which is instead of paying us back, they will trade that money in that we lent them into stock of the company. But later on, after they raise money into another equity round. That's a convertible note, yeah. Let's see. A lot of them have ownership strategies. So they say, like, no matter what we put in at the first round, we must capture 10%. Okay, so all their economics are calculated based on that. A lot of to be less sensitive valuation as long as they get their 10%. Okay, so there are advantages to getting one of them to invest in you. A lot of them will also raise follow-on funds, so you get support after that first round. Typically, they're looking for multi-billions in market size. That's actually a trend that I've seen over the years. Used to be that a couple $100 million was good enough, and then that quickly moved to $1 billion. Then it moved to several billion, and now it's into the tens of billions. And if you don't have that, a lot of these guys won't even touch you.
What are the follow-on funds?
Oh, so a fund's typical strategy is when you invest the first time, and if the company's doing well, you want to follow on with another investment to either maintain ownership, especially when more money comes in later from somewhere else. Let's say I always want to keep 10%. So when I get diluted from the next more money coming in, I go, well, I still want to put more money in to keep 10%. Okay, something like that, yeah.
Usually 10%. That's like traditional here.
That's just one person's metric. From fund to fund, it's different. It can be as much as 20%. A lot of people say, well, I start at 10% and I'll fight my way to 20%. So there's a lot of these different ways that they're using that, but a lot of people do use 10%. Let's see. So advantages of seed and micro VCs. They often have huge portfolios, so you can meet a lot of people and get a lot of help and do business with them even. They can help you around, including their own that they put in there. They have a lot of money to support you if you need bridging. If they don't follow on, there's less what they call signaling issues, meaning like if I am a big fund and I invest in you and then I don't put more money in you, then other investors will go, what does this guy know that I don't know that he's not putting more money in? Wait a minute, what's going on? Okay, that's called a signaling issue. They have a lot of experience because a lot of these guys have been around for a long time. Disadvantages, your metrics for success can change once a professional VC is involved, even at seed. So a lot of these guys are still going for their 10x. That could mean that, well, if someone gave you a smaller offer, which could land a couple $1 million in your pocket, you couldn't take it. You'd have to work with the micro VC to get what he needs to get out of the exit as well. And the reality is, if they have huge portfolios, it can also mean that they never answer the emails and they never answer your calls either, which really stinks, but it's just the reality of having so many startups to manage. So oftentimes, large venture funds will also come down and do seed. Okay. So if you look at the top 10 most active seed funds across every kind of fund, you can see that there's a bunch of these guys that are also pretty big funds. Okay, down here too. Well, this is probably too hard to look at, but if you include everybody, then Andreessen Horowitz, I mean, is number 2 here, right? It's like there's a lot of people in here that do seed that are the big funds. So why did they start doing it? Right around the time I started investing, back in 2006, 2007, they started seeing a ton of innovation, didn't want to miss out. So they started putting money into early stage companies and did a lot of investing because they didn't want to miss getting into the companies that were that seemed to be taking off and getting investors another way. But then they realized that they couldn't manage all these investments, that they're putting random money out there, and so a lot of people pulled years and stopped doing it, or they started doing other things. And especially when their investors expected them to manage their bigger investments, which meant more money for them, they couldn't spend time on the smaller investments, which would not, yield as much money. A lot of these funds can put in anywhere from $50K to $250K, or up to just leading the whole seed round. Some of them will do all that. So advantages, disadvantages of taking seed funds from a big VC. Advantages, if they love you and you're doing great, then they're going to give you more money later, which is awesome. And that's oftentimes it's a large sum of money when they first give that to you. A lot of VCs these days have a lot of personnel to help, as well as their portfolios, so that's good. But there are disadvantages. I've had a couple startups get caught by the signaling issues. I had one startup with 3 big VCs as part of their seed round, and none of them followed on and did the next round. And it basically just collapsed their whole next round. And the reality is, they're busy people. Oftentimes the help maybe like 0, because they're just too busy with the other stuff. There's also been a big rise of what we call strategics, which is basically corporations which could acquire you, investing into seed as well. So you can see from 2010 to 2013, it's grown 38%. So what kind of goals do these corporation VCs have? Sometimes it's just to extend and enhance their own corporation's capabilities. So like somebody like Cisco Ventures, this is the food company, not the big networking company. They only invest in food-related startups or food technology. Return on investment's always there. I have a couple friends at Hearst Ventures in New York, and they've often told me that they don't have any restrictions in investing in anything, including competitors of things that are in the Hearst corporation. As long as they're making money, they don't care what they invest in. Strategic learning, it's pretty straightforward. Look out into the industry, what kind of innovation is happening out there. Then you have people who want to just foster innovation in their industry. So somebody like Intel Capital, I've talked to a while back, says as long as we invest in stuff that leads to more sales in computers, which means more chips bought, then they're okay with that. They like that. So advantages and disadvantages. You get access to a lot of information and help and potentially partnerships with that corporate investor. And it provides a potential for a future exit, which is really good. That happened to me once, which is great. But the disadvantages means like, well, if you're not doing so well, it could limit your exit options. And it could limit who invests in you later, because there could be another corporation who wants to invest in you, but they wouldn't do it because they say, oh, well, my competitor is investing in you. Why should I invest in you? All right, so after you raise your seed fund, everybody goes for Series A, right? So it's the first round after the seed round. It's typically between $4 to $10 million. Recent years, a lot of these funds have struggled with going lower than $4 million because they've raised such big funds. They want to put more money to work. They don't want to keep throwing $2 million checks out. They want to put 4 and 10 or 15, $20 million. And they typically try for somewhere between 3% of the company at this funding. So if you need to raise, you can automatically calculate out what you think the pre and post money valuation could be, at least at the first meeting with them. There's always people who are outliers who raise like 10 million on 100 and all that kind of stuff. But most of the time, it's probably going to be in this range. A lot of people doing Series A. I think this list even goes down below that. We always wonder now, is seed now the new Series A because they're doing greater than $6 million in the first round. However, I don't know if you've heard about the Series A crunch or if that rings a bell or not. I believe it's real. And here's the graphs that basically show that. There's been an explosion of seed startups. This number goes out to 2012. I'm looking for numbers to update this. You can see the number of startups is just growing. But there's not enough Series A's because not everybody gets them. So if you total that, 418, 15, that's not anywhere near as much as how many startups there were. Okay, and that number is climbing. The gap is widening. So what do? We pretty much have to bridge everybody we invest in. So what that means is after they close their seed round, well, before their seed round, I try to talk them into raising for 24 to 36 months, and they almost always say, no way, Dave, you're crazy. So then we close the round, and then they literally, a couple months later, they will come back and ask for more money. And many of them have been bridged twice before they were able to land their A. So they were lucky that they had investors who could support them after, even though they had not gotten good enough metrics for a traditional Series A round.
Is it that because, I mean, if you are getting a lot of money in the seed moment and then you are expected to really do well in 24 months, sometimes it's too aggressive, right? Much at the beginning.
So you're asking whether or not it's too aggressive to ask for too much money at the beginning?
Yeah.
I think
Even too much performance, like that, then because then you don't reach the Series A, right? So you end up not performing what you propose to do. Is that it?
from where I stand, as the guy starting this process, it almost requires $2 or $3 million anyway to get to either break even or metrics good enough for a Series A. And I'll talk about metrics that some Series A funds are requiring in today's world. It's a lot harder to get a Series A. So now I have to make more money. I have to get more progress, get more users than ever before. So we have to stay that way longer. So yeah, we raise $1 million, $2 million, whatever, but it always ends up being like $2 or $3 million raised by the time they get to getting the next round.
And the seed money is not giving that usually. The seed money
Not the first round. It's just not enough. Unless you're super lean, like there's two metrics, right? People forget They go, oh, I cannot change my lifestyle. I still need my Tesla. I need whatever. So I need to double the amount of money. Dave's saying I need to not raise for 12 months. I need 24 months. So instead of raising 1 million, I got to raise 2 million. I go, no, you could actually spend as much, and then you could last twice as much. But not many people are willing to give up their livelihood these days for their startups. It's kind of it's an interesting thing that's happened. I think too many people come to Silicon Valley feeling entitled, if that makes sense, that word. They feel like everything should be given to people. I don't know. That's right. So, okay. So one of our guys, research guys, did some calculations for 2013. We guesstimated there were about 2,500 by the end of last year, and that number's probably grown to, I don't know, over 4,000 by the end of this year. There's just too many startups out there. And then the Series A level still says the same. So what are we going to do with all this gap between here and here? We got to bridge them all, I guess, or they die. So what does Series A funds look for? They want startups ready to scale. When they give you that much money, their first question is, well, how are you going to spend it? It's like, if you're going to spend it by experimenting, it's like, no, I don't want you to spend my money experimenting. I want you to spend my money to make more money. So they like to see proven product market fit. You got to be really prepared on your metrics. How many users coming in for this reason, that reason. You got to know your marketing channels, because this is the key thing. It's like, if a VC sees that I can pour $5 million down this channel and make $20 million back, that's easy for them to say yes or no. And also, one note is these channels must be scalable. And what I mean by that is you need to be able to keep pouring money down these channels and not maxing them out. So like, say, Google AdWords is a pretty infinite channel, although it probably gets more expensive as you pour more money into it. But we found in certain instances where the most effective channels have been like, but they only have like 10,000 people coming. So I can only put that many ads on it and that much money into it, and I'll get that much back, but I cannot put more money on those blogs. It's kind of almost an unscalable channel. Funds always, go ahead. You just have to know your business inside and out. And we've seen, if the CEO can go into a pitch and if the VC zings them with a question like, so what's your balance sheet, blah, 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 look like? And you just like whip off that number, it really impresses them. Because it just kind of shows that you know your company inside and out. So internally, the economics, but also the economics externally, meaning how do I make money? If I get 100 people in, I know I can make this much money. If I get 1,000 people, that kind of thing.
What about the like revenue versus users? Because here I'm hearing a lot about users. Like, you want users in the platform, and then someone will come that will know how to make money out of it. Is it really what it is?
There's a great post out there by Chris Dixon called 10 million is the new 1 million. Ever read that? You can Google that. It's basically like, used to be that if you got 1 million users, they would give you your Series A. That was like back in 2000. But then it's been probably 3 or 4 years now since Chris wrote that post. But that 1 million turned into 10 million. And actually, I think 10 million has turned to even more than that in today's world. Especially, let's see, is it the next slide? Yeah, okay. I mean, imagine how many users you would need for 50,000 daily active users. I mean, it's a lot. I mean, everybody can get 50,000 per month, but to get them to come back consistently every single day, 50,000 of them, that's a lot. That's a lot of users you got to have, depending on what you're working on. So you will find some VCs who will back you and say like, yeah, you're the new WhatsApp, right? You're coming in with like 20 million users and they're all blah, 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 doing something. There are people who will back you for that. Snapchat, not making any money. But they've raised a ton of money too. So I would say that in today's world, building one of those kind of things has never been harder to do than today. Okay, it's just too crowded for consumers right now. Too many things to play with. It's really hard to get something that someone's just sitting there every day going many times a day on. But if you can find it, somebody will give you money. Other types of things are like e-commerce has been beaten down quite a bit in the marketplace today in the U.S. I mean, think about making $1 million a month at seed, that's a lot of money. That's $12 million a year. Give you like a $3 million on 8, for that. That's VCs don't like e-commerce these days. It's getting really poor exit multiples, so that's what affects some of these numbers. On the other hand, if you look at business-to-business software as a service companies, they only require 1 to 1.5 million annual run rate. That seems pretty low compared to like $1 million a month selling product. But at least until about April of this year, B2B SaaS companies were exiting at well over 10x their revenue. Okay, then around April timeframe, that dropped to 6, and it's stuck there since then. But it's still pretty good. Right now, e-commerce exiting at about half to 1.0 revenue. Okay, so imagine $12 million a month company only being able to exit for $12 million or 6. Okay, but yeah, these what we call bars or minimum requirements, they're just getting harder and harder because we investors, we're looking for filters. Like, how can we filter when we have thousands of startups up there? I'm always like, well, last month it was 500K. There's too many startups. I got 100 showing up to 500K. Well, I'm going to make it 1 million now. Whoop, they all dropped off. Now I can go and just see the guys that come up the top. Right, it's pretty simple. All right, how do you meet these people? Here's some of the ways pretty well. First, meet other entrepreneurs, become friends with them, then ask intros to their investors. If you pitch them and they love you, then they'll definitely want to refer you to their own investors. A lot of conferences are good. Some of the 500 startups ones, like these two, this pre-money one is a 500 startups one, is pretty good. That's where a lot of people can find out what the VC community is thinking about. Post-seed is coming up in December. I'm looking forward to that one. That one's also in San Francisco. And then that's a famous one. A lot of those other startup ones that a lot of investors wandering around in. AngelList has actually become a really good place. You can send messages to people. You can ask for intros. You can also do searching for good investors to look for, because you can look for similar startups and then generate a target list of those investors, and then go find those people who you know are interested in, say, your category or your industry of startups. Every venture capitalist, venture fund has a website email address. You can try that, because sometimes it works. There's often a bunch of associates who are basically given the job of reading through all these emails and looking at every single email that comes through. But then, don't be surprised if no one answers your email. But there are some that actually comb through them. And one of my favorites down here is just join an accelerator. Apply for one. Like 500 Startups is really friendly to international startups. There was a couple from the Czech Republic, I think, and Ukraine most recently. But I think demo days from any accelerator are some of the best ways to meet investors. All right. Well, there's a lot of investors out there too. Well, how do you pick them? I would research them. Like, what kind of investments have they done in the past? Especially if there's something competitive to you, because a lot of people may try to meet you and try to find out everything there's about you, and then you realize later, oh, geez, that guy, he invested in a competitor of mine. The reason why he was meeting with me is to find out more about me and to tell him everything I told him, which really sucks, but that does happen. You should also find out, how are they helpful? A lot of funds, the people have different experiences, so they can help you in many different ways. And I would definitely call for references. If you find somebody, I would ask for people to talk to, either in the startups that they've invested in, and find out, are they really helpful? Do they answer their emails? Do they answer their phone? Because oftentimes a lot of these guys say they will do all this stuff, they give you the money, and then they literally disappear. You just don't even find them anymore. Find out what their investment criteria is. Do you fit it? And if not, it may be a total waste of a meeting. Like, one of our criteria, I just tell them up front, is we have a $4 million max on valuation. That's a cap on a note or a pre-money. And as soon as I tell them that, I think most people just don't even answer my emails anymore. But hey, we didn't waste each other's time, right? Also, you might want to find out if they're investing actively now, because for a lot of traditional venture funds, you got to find out. Actually, let me back up. A lot of funds have a set life. I don't know how much you know about how venture funds is set up. Basically, the life of the fund is something like 10 years. And then they break it up into, like, say, 5 years. In the first 5 years, they call that period the period where they can deploy money. And then the second half of the 5 years is what they call harvesting. So they don't. What happens is they only have 5 years to invest the money, and they're taking management fees. And they usually take 100% of those management fees up to that 5 years. Then often times after that, they still take some, but they don't take as much as they used to. So there's a lot of these things that can happen, and you may find out that some fund is meeting with you, but yet is at year 4, year 5, and they may actually be out of money, or they may actually be only putting money back into their other startups that they've invested in. So it's worthwhile for you to ask, like, what is the life of the fund that they're investing out of? If they're just raised that fund, they're looking for people to spend money on, so that's the best time. I would check on alignment and vision. So do you and the investor agree on the direction of the company? I've often met some guys with great technology, but then I go like, you know what? You guys are working on the wrong thing. You need to do this. And sometimes in my earlier days, I would think that, oh yeah, I convinced this guy. But I've since learned that, you know what? I almost never convince him. And it's always like a wish that I have, which almost never comes true. So I would suggest that you and the investor should agree on it first, so to make sure that later on you don't come into conflict. And that goes for personality too. I mean, there's some people out there who I'm not sure you really want to work with or spend a lot of time with. They may have a lot of money, but man, they may be real jerks. I don't know if you want to spend time with people like that. I think there's a blog post written by someone who was at Posterous, talked about, would you have beer with your investor? And that would be like the way to select your, people who invest in you. Also, like style too. Working styles can clash. They may not be good together. So check on that too. All right, so you're all international startups. So a lot of stuff I talked about. Actually, there's two things. One thing I'll talk about first, but the other thing. The first thing is, this is really for U.S. startups, people who are based here. Okay, and it's also about really internet, software, and I would say hardware startups. There's some people in the audience, I think, from biotech industry. Is there? No? Okay, one. What about something else? Clean tech, maybe? Clean tech? Okay. All right, so I'll try to cover a little bit of those after I get through everything. All right. If you're based internationally, it can be really hard to raise money from the U.S. Everybody wants to come here and get money, except that you'll find that a lot of U.S. investors just won't do it. That's because U.S. investors like to be close to their startups. So if you go back to your country, hey, what happened to my money? Is it making money? Can I help you? What happened to it? If it's a fund, sometimes the fund itself, its charter, may prevent investment outside the U.S. So for instance, our accounting firm actually prevents us from investing outside the U.S. And a lot of that's because we're scared about dealing with the tax laws. So a lot of times we get double taxation if we try to invest out there and then we try to bring the money back. We get taxed in the country and also in the U.S. when money comes back. And generally, if we don't see the startup, we don't see the entrepreneur, we don't know if bad things are going to happen. And certainly with the thousands of startups running around the U.S., there's plenty of things to look at over here. So how do you fix that? Okay. Well, the first thing is, how about moving to the U.S.? So the first try you might do is move the parent corporation to a Delaware corporation. And then the international company will be owned by the United States Delaware corporation parent. Okay? So when you collect investment from the U.S., it goes into the Delaware corporation. This is better than being fully international, but if you're not here physically, it still may be a problem. A lot of the 500 startups international investments are all like this. Everybody's required to create a Delaware corporation and then legally put the international corporation as a subsidiary to the U.S. corporation. All right, so what's the second thing to try? Well, let's try moving some of the team to the U.S. This is better because then they have people they can look at and visit with. But if your business is still overseas, then the question comes, well, if you're making more money out there, what are you doing here? Shouldn't you be over there making the money? Well, next thing to try after that is move everybody to the U.S. or some of them, or and also do business in the U.S. So this is the best case, even if you started overseas, but you're trying to enter the U.S. market. Okay? And a couple guys have successfully done that. They've moved here and brought most of their business here, even though they started overseas. This way, investors see that you're serious about being here, so that's a good thing. And I mentioned 500 startups. There are some accelerators who like international, so you can consider applying to 500 startups. There's a couple in Europe, Seed Camp. Seed Camp has a bunch of affiliates now across across Europe. So before I end, I wanted to talk a little about clean tech. I don't know that much about, but they both have. But biotech and clean tech, I think, have similar characteristics. The industries have been around for a while, and they also take a lot of money to build, right? And so what we've seen in clean tech is there was an explosion of investment, and then all of a sudden now it's kind of like died off. I think there's probably going to be because we're seeing in at least out of Y Combinator, they're really supporting some energy startups, which I find is really interesting. So I would say maybe less clean tech, but maybe just energy in general. Whether it's clean or not, I don't know. Hopefully it is clean, but there seems to be some possibility that these kind of startups can take off again. Biotech I know more about. I started investing in biomedical devices probably 2012, I think it was. I was really curious. It seemed like an opportunity. We were doing a lot of it out in New Haven on the East Coast, so I decided to look into it. So what I found out was it's been around for a long, long time. It's a very mature industry. And I also split it into actually 3 categories. There's biomedical devices, there's pharma, which is like drugs and medicines and that kind of thing. And then there's a third one, which we call, it's more like a melding of internet software. I call health IT. So it's like websites that treat you, or you can communicate with your doctor, through your mobile phone, that kind of thing. So the last one's the easiest one. All you got to do is follow the rules of normal internet startups for that kind of funding. A lot of that stuff gets lumped in there, even if it requires FDA approval. So the Food and Drug Administration approves medicines and devices for use in medical purposes in the U.S. But for biomedical devices, I found out that for a long time it was great, and then all of a sudden it just the opportunity just wasn't there anymore. The big acquirers stopped paying lots of money for them, and plus they built up huge patent portfolios which made it really hard for new guys to start something. We actually have one in a portfolio that got sued by one of the big device corporations out there, and I think unfortunately we lost, even though I think our patent was valid. But when you're a startup and they spend lots of money against legal, right? It's hard to survive something like that. So we still tried. We think most exits happen between $20 to $50 million. That's our target for biomedical devices. We get somebody funded through FDA approval, and then immediately we try to go for sale. Okay, so one of the big acquirers. But in the last year or two, so that some of these acquirers up top have started consolidating and joining together. So there's a lot more busy with big mergers and acquisitions at the top. And what's happening at the bottom for some of these devices is that they are now requiring traction and revenue, which is pretty hard because all the channels that go into doctors and hospitals are all locked up by the big corporations. How do you go sell a device to the thousands of doctors out there by yourself? And also making sure that insurance will reimburse you. So a lot of medical devices here make a lot of money for people because the insurance is willing to pay for it, because normal people here in the U.S. don't think they should ever pay for medicine here. So one of the things that at least I've started doing is re-looking at whether we should continue to invest in biomedical devices. even though some of them seem interesting, but it takes a lot of work to learn the industries. And then the exit potential now is even less, because once we give them money, then we know they have to raise enough money to actually get into market with product and start selling it. So it's getting really hard to raise money. Age investments dominated by angels and angel groups. I'm a member of the Life Science Angels here in the Bay Area, so I get to see a lot of stuff, and it's a great group to be part of. There's a bunch of them that I've gotten to know over the years. They're all like into biomedical devices, maybe some small medicines and pharma, but very rarely that, because that's even in a different path of difficulty to get to market now. So that's about all I can tell you about biotech and clean tech. All right, any questions, comments? Yeah. Yeah, sure. I'll send it to somebody here and they can forward it to everybody. Yeah.
There is a catch-22 with moving to the U.S. because you need money for that. And the local investors in your country don't want to put money for you to leave, and the investors here don't want to put money because you're here. So, do you see that problem? Any ideas?
I see another catch-22, which is, to me, sitting here in the U.S., I put out the slide about early stage bubble. I think there's actually less opportunity here in the U.S. However, there's more money here. So that's the catch-22. I think there's less opportunity, unless you find that secret thing that there has no competitors. So like one of the things I invest in now is, or the criteria I invest in now is, it's got to have no competition. And I'm okay with traditional offline competitors because pretty much everything has something. But I don't want to have another startup that's sitting in Boston or New York doing the same thing that I want. And that's worked pretty well for me. We got a couple startups that have no competitors even after a year. And they're starting to make, like one guy's doing 6 million top line, the other guy's going to do 12 by early next year. It's like, it works. We just stopped investing in the photo sharing apps, that kind of thing. Market has to be multi-billions, and then it usually means it's in a unsexy, untapped market, something that nobody's ever heard of before. We just did one that's connecting landscapers with the growers that grow the plants that they need for landscaping. I didn't know this, but it's $30 billion in the U.S. every year of plants being sold for that. And the other thing I didn't really realize was there's actually landscaping firms, more than one, that are making over $1 billion a year, just taking care of people's lawns and parks and whatever. It's pretty amazing. A couple, like 4 that make $1 billion, and all of a sudden there's a couple of 5 or whatever that make 900 million, and then it's pretty amazing what that list looks like. So yeah, we work hard for that. But yeah, I think sometimes I tell international people, why are you coming here? The opportunity's back in your country, right? Your country needs your country needs the social networking. The country needs the Snapchat. You don't have one. You should build one there. But you're right. All the money is here, though. That's the catch-22.
Can I ask a follow-up question?
Sure.
With respect to having no competition, one of the problems is that you also have no similar startups. So you really don't know which investors will invest in that area because it's new.
I've experienced that firsthand, actually. Sometimes we'll find one, and then we spend a lot of time. Sometimes it'll take like 2 months for our research guys to dig in. We're looking at stuff. We do phone calls. We're looking at it. Then we go, okay, this looks real, Then we got to take this and convince other people that it's something real. And it's really hard, actually. It really is. Almost everyone that I've done, we've had to spend a lot of time with. I share the research deck. We go through it one by one. But also, what's been nice is over the last 2 years, I've kind of built a little bit of this unsexy investor crowd that we tend to like the things that our team finds that's a little bit off the beaten track. Yeah.
One question, and regarding the point that you said, right? The money is here, but less opportunities here. In that case, Rocket, right? The German group.
Rocket Internet? Yes.
I mean, in that case, how they did it, because somehow they found a tax that they could invest in every other country, copycat what is here. So they put a solution to this problem here. You agree, and do you see alternatives? Because they copycat themselves. They don't invest in other entrepreneurs that
That's right. Well, they copy. It works in the U.S., but there wasn't one in Europe, right? So the markets, they tend to be separate in a lot of ways, right? Sometimes by culture or language. I worked for many years in international at Yahoo. I got to learn that firsthand. Um, Asia, Taiwan, everything, everybody's a little bit different, and you can't just work on. That's one thing that I think Yahoo didn't ever learn. At least maybe it's changed now, but we tried to run everything from Sunnyvale, and it's not possible. Like I remember talking to someone in the Yahoo Germany team. There's like 20 guys in the team, but yet their closest competitor, like a huge media company, was building almost everything that Yahoo had. And they had like 500 guys doing everything. Like, how do you compete against 500 people with only 20 people? You just can't. But I think also Rocket Internet was a bunch of guys. They had a lot of money, personal money, as well as raising money. So I think when they started something, they just put their own money into it and then got it going, and then just pushed the hell out of it into the marketplace.
Okay, was it because they were not Americans that they could do this investment abroad easily? Because, I mean, you mentioned, right, tax for you guys is really a big issue, but for them it wasn't. Isn't that because of U.S. and European?
Uh, are you saying that the Rocket Internet people were getting money from the U.S.?
No, the tax issue was
Yes.
not a problem because it cannot hurt profits so much as here, right? Otherwise, you would also invest in other countries, I'm assuming. The tax laws that are forbidden, and I guess, I mean, you have too much opportunities here.
Yeah, so part of it is there's too many opportunities here. Why deal with the tax problems? Now, the tax problems over these last couple of years have actually gotten better. Okay, like Canada, for example, I don't know when it was probably 2 or 3 years ago, but they started letting people invest freely across the border with no double taxation at all. But there are still a lot of countries that do have double taxation. I think the U.S. is actually the worst of that. Anytime you try to bring money back in, you get taxed here. It's almost unfair to other countries, I think. But we're like that. Yeah. Can you re-ask that question? I didn't quite. And I thought there were two. So which one do we? Yeah. Well, let's see. The exit. Are you asking about the exit? How important is it for us to see the exit when we invest? I think in some of the unsexy, untapped stuff that we've done, we look at it and go like, I'm not sure what the exit is. Who's going to buy a landscaping grower plant marketplace, right? But if they can get a big chunk of that money, right, then we're talking about IPO, and somebody's going to want a company that is making hundreds of millions of dollars a year, right? So we worry about sometimes we worry about it later. Other times we do some thinking and going, oh yeah, maybe Amazon would buy them, or whatever. So yeah, I think it's always in the back of our mind, but I think for some of the newer opportunities, we'd rather just get in there with a company and capture all that space first, and then worry about it later, as long as there's a lot of money to be made in it. So let's see, global corporation. I think if you look on most metrics for business in general, I think the U.S. dominates in so many different categories. Like a lot of people, actually we have a gaming startup in our portfolio. I always ask them, like, why aren't we launching here? And then he shows me the metrics about how much money is made in the iTunes app stores for for the U.S. versus some of the other, say, English-speaking ones, because it's easy to launch English-speaking ones across different places like Australia and Canada. It doesn't even like come close, like how much money is being made. Now, that also means that it's a very crowded marketplace. But you look at that and you go like, why can't I go and try to get a big piece of that? Yeah, and I think there's still opportunities in a lot of places. People like to talk about how much money is spent in offline advertising, but yet online advertising is still a small percentage of that, and yet online advertising has been shown to be more effective in tracking and all that kind of stuff. So why not people? Right, there should be some more money being made, but of course everybody thinks that too. So there are a lot of people working in that space too. And yeah, a lot of people complain like, oh, we're running out of page views and we can't get enough impressions, and all the sites we'd rather buy ads on have run out of inventory. But yeah, I mean, people want to come here to do business. Yes.
Скажите, пожалуйста, вот это вот построение бизнеса обязательно в США, это касается это требование всех инвесторов? Это Подскажите, переведите, пожалуйста. Построение бизнеса, вот он сейчас сказал, это требование должно быть в США. Это обязательно требование всех инвесторов, ангел-инвесторов или
So, David, the question is that requirement for coming and registering the U.S. corporation, preferably Delaware corporation, is it standard for all the VCs, angels, and everybody, or there are some that would look at the company that registered someplace else?
Well, right now there's a lot of funds that are U.S. based, but they have international divisions. You can always go talk to the people at those funds that are part of the international divisions. But yeah, that list. There's a huge list here in the U.S., right? But that list is not as big in the UK or in Europe, and it's unfortunate. But yeah, I think we're probably a few years behind the U.S. in terms of this kind of stuff, this funding. I mean, things are moving, but they're just not moving as fast. We may see. I think we're going to see more funds being built. Some of this has to do with the state of the economy and how the global economy is not really doing all that well. And you try to put money in our normal bank account or our bonds, and we can't make money that way. So everybody is saying finally, oh, I got to put money into startups because that seems to be where the money's being made, although I could tell you it's definitely not being made. But yeah, it's not a guarantee. I think it would help, like all those, right, first try, second try, third try. The more you can show that this is possible, that you're going to do this, the more likely you'll get investment. Now, there is a harder way I just thought of. Family offices might put money in you. That's back to angels. And these are really wealthy, either individuals or entire families. Launch Capital is actually a family fund. So we help one branch of the Pritzkers. It's a family that's known for the Hyatt hotels and this other thing called the Marmon Group, which got bought by Berkshire Hathaway for many billions of dollars, and everybody in the family is rich because of that. But we only have one family that we service. But there are a lot of family offices who don't worry about taxation and all this other stuff and are willing to put money overseas. But when it comes to traditional venture funds, you have to really look at, do these guys really, are they allowed to go international or not? And often in how they raise their money in that charter, they cannot.
Sorry, I've got one more question.
Sure.
About introducing yourself. Let's do a hypothetical. You've got unique capability. There's no competitor. You have intellectual property in the process of registration. And the person you want to speak to won't sign a non-disclosure agreement. What do you do?
Oh, yeah. So for a long time in the U.S., non-disclosure agreements was kind of like one of those things you would do. And then when the internet came around, then nobody would sign NDAs. And a lot of that was because we meet so many startups, and it's possible that we that's doing very close to something you're doing. But if I had signed an NDA, then with someone else, I may not be able to even talk to you, even a little bit, for that investment. So, and over time, if I kept signing them, I'd have to keep track of them. I had to like go, oh shoot, I can't talk to another farming startup because I signed an NDA. It just became unworkable. So I think you'll find in today's world that very rarely will people sign NDAs before investment, whether you like it or not. You just have to trust people. So, so the I think is investors now care about our brand and reputation. So if you ever found out that that guy Dave Shen like told your competitor about whatever, then that could spread around Silicon Valley and no one would ever come to me again. So there are some checks and balances in today's world. Yeah.
If you know all these all the European companies have these patent box regimes where if you have these patents you can park them there and it's all tax free then. So if we just move to Delaware Corporation, it's 30% straight away and you're just kind of raising 10% down and you're kind of paying 30% tax. You're kind of giving away 40% of your profits to raise. And so do you think they would be okay with probably the Delaware Corporation owning 10% of the bigger piece? Or?
It has to do with the exit, right? So, yeah, because they don't want to go buy your thing and then realize, oh, I'm just going to give 10% to the Delaware Corp. Right? That doesn't make any sense. Yeah.
There's no patents box regimes here in the U.S. You're not aware of anything?
I'm not familiar. Yeah. I'm not familiar with that. Yeah. You'd have to ask probably a good lawyer for that. What else? Yeah.
Can you comment on these singular agreements for equity, which is sort of convertible notes that they specify in the case of a liquidity event, this will happen in the case of this notes?
Is there any particular comment or just generally? So what that gentleman was asking about was safe docs, simple agreement for equity. Safe is not so safe, at least according to us. But I think a lot of people, especially Y Combinator, they're searching for ways to raise money faster and cheaper because startups don't want to spend money dealing with legal stuff. They'd rather be building stuff and doing other things. So the first way that was done was with a note, and then people realized, well, a note doesn't have any conversion caps, so then they added caps, and then we started adding all these terms into the note with the cap because we didn't know if it ever turned into equity or not after that. So we added even term sheets in the middle of it, and it got pretty big and unwieldy. But that's what entrepreneurs demanded. So we said, well, if you're demanding that, we're going to throw all this stuff in there to protect ourselves. And then along came the safe doc, which I look at more like is it's an option to purchase equity at a certain price. Okay. Now, there are differences between a note and the safe doc. Safe doc often doesn't have interest rate. Safe doc has no right to pay back. Okay. The note is a true loan. Okay. Safe is your money's gone or turned into equity at some point. There are some nice things that I've seen in safe docs, like giving us pro rata rights no matter what. Because I've seen cases where I had money in a note, and then when the Series A guy came in and I converted into that round, they like to do things like put major investor clause is $400,000. Put in only 100. I guess that knocks out everybody that came in the first round. They like to do stuff like that because they want to take, pro rata for themselves and not share it with anybody. Which I think is a shame. We spent all this time to build early stage startups up, and then the later money just kills us later. It's really disappointing to see that. What else about safe docs? Yeah, I think that's pretty much it. If you have any specific questions, definitely ask. Am I done? Almost. 5 more minutes. Any more questions?
Okay, so
Go ahead. Yeah.
okay, in terms of milestones, you said, like, okay, to get a company to
made a mistake. I would say it takes 24 to 36 months. And so how much money that is required to do that is dependent on your burn. So usually it's about, it looks like 2 to 3 million, but it could be less, right? It depends on how much you burn. Okay.
Then you put it, so okay, like in 5 months you need to have this, then I'll give you another. The seed money works or no? It's one off and it's done.
In the past, it's worked that way. We haven't done that.
Like one off.
No. Tranches, investing with tranches. I've never done it. I have only been part of one round that's ever done it. Some of my guys in Boston and New Haven have done it for other types of things, but it's very rare that someone will put milestones on you because it's so variable these days. Yeah, but there's always a commitment, right? Like if you made those milestones, we can't back out, or well, we could. I have a friend of mine who actually backed out, who had an investor backed out, and it crashed their company, which really sucked. Yeah, it could be less risky. But I think in today's world, with generally the startups we meet, some of these metrics just are not achievable. Like you cannot predict, yeah, I'm going to get $1 million. It's just like keep hammering away at it, right? I'd rather give them all the resources when they need it to try to work it the hardest to get there versus saying you got to hit $1 million before I give you another 500K. I mean, there could be some funds still doing that. We invest only 150K into startups that we do, so we can't do that kind of stuff generally. But bigger funds could potentially do that. Yeah.
You mentioned also.
There isn't enough incentive for him to work on the startup because he's getting paid a normal salary. Now, I should say this: engineers are getting paid ridiculous sums of money. So, like if the competition from Google and Facebook for that, I mean, 200, 300, 400K, for a really good engineer or more sometimes. It's hard to compete and get somebody to work for you these days because of that.
So having founders that are engineers is an advantage.
Yeah.
Pay less because they're founders.
Yeah, the best way is you got like 2, 3 guys and they all can code for a technology, software type startup. And then you can kind of do a lot of different things. I would say it's probably hardest for like a business guy who doesn't know how to code to start a company because you need other guys to do stuff for you. So it just naturally becomes more expensive. What else? Anything else? Okay. Thank you very much.
David, thank you very much.